to MTM with your host, MTM. And in today's video, I wanted to discuss M's and W's, also known as double tops and double bottoms. So let's jump into that and let's see how we can capitalize on these really cool patterns that form. So some of the topics we're looking at is what is an M and W pattern, what is the significance of these patterns, as you can see here, what is the psychology behind these patterns. Now, here is a bit of a secret. There is the retail way of looking at these N's and W's, and then there is the market maker way of looking at these N's and W's. If you're new to the channel, I will be talking about trading as well as looking at it from a market maker perspective versus a retail trader perspective. And the other part is, how can I and you capitalize on these M and W formations? How do the masses enter these, and how do the pros enter them? So let's look. So what we have here is we have a M and W pattern known as a double bottom making a W, and we also have a double top making this M structure over here. Now what you see here are what are called equal double bottom and double tops. There are advanced variations of this, which I'll cover for people who are more experienced pro traders. I'll be covering that in a separate video. So the M and W pattern effectively is when the market is due to reverse in either direction, you'll have a double bottom reversing it and heading upwards, and we'll then have the double top reversing it and heading downwards. Now, the significance of the patterns, like I said, is that retail traders will use this in order to understand a new trend is forming, or the market makers will use this in order to book profits and to make sure that they are getting the things that they need and setting up for the next cycle of events that they need to have happen. Now, double tops and double bottoms do appear in other markets besides Forex. So you have your stock market, you'll have your options trading and so on. They typically will be in these things here. Forex is the market that we are concerned in, so we'll see a lot of double tops and double bottoms when you go back and do back testing, and when you go back and look at the charts over time, no matter what the pair is. Now, there are hundreds of different patterns. There are a lot of strategies that uses a double top and a double bottom in order to make money, which is great, which is why we're all here for as traders. And what I want to do is teach you how to spot them like a market maker would, and really get behind the psychology as to why these double tops and double bottoms are important. So let's continue on and see what else we get from it. So as I mentioned, there is the psychology of trading these patterns, these formations. These happen for a particular reason. Now, if you're a retail trader, and if you've come to the knowledge of learning retail trading through, well, lots of websites will easily teach you on these patterns, a lot of ways thinking about it is thinking about this. You'll have volume, you'll have breakout trades, you'll have buyers and sellers moving the markets in one direction and another direction, and all about support and resistance. All that stuff is typically there. But if you think of it more as a market maker, what are you trying to do? You're trying to earn money. But what you need to do in order to do that is to induce sellers or buyers to go to a particular direction. They'll also have stop losses. Now, those stop losses will be in a certain position. So we come back over here. And if I show you here, so if my stop loss, if we're taking this W here right now, what we're seeing is the fact that we're seeing here, let's move over here. What we're seeing here is that we have the first leg coming down here. And for a lot of people coming out of agent session, that's inducing for a breakout. Then it comes back up, and then we're coming back down again. Now that's going to be interesting as well. Now for the M formation is also the same thing, where we have it coming up, neckline, breaking out, coming back in, and we're coming upwards. Now what typically you see as a retail trader is you're expecting this to come up, down, and continue downwards. Whereas you're seeing with this M pattern over here, you're expecting it to come up, down, and to continue going upwards. So if you think about it, for some other indicators, you'll have known as the A, B, C, D formation. So A, B, C, D, and it moves upwards. Now, that's where the psychology behind that part is. Now, for the market makers, you're inducing people to go long or short, tricking them. They'll have their stop losses either above or below, as told to them by the retail trading institutions, and then they'll be coming either back up or back down for that second retest. Now, in another video about advanced M or W patterns, I'll be talking about higher or lower second legs and variations of that as well. So please stay tuned, like and comment and subscribe, and also suggest any videos you would like me to produce on these trading topics, and I'll make sure to go ahead and do so. So that's psychology around it. It's making sure to induce traders to go long or short, and then going the direction where the market makers would like them to go. So let's look at the charts in a moment to get a bit more insight, so we can make sure how we can capitalize and see how we can get in, and also making sure that when we do go ahead and do so, that we are going to elevate ourselves to the next level where we need to. So let's talk about how to capitalize on the patterns themselves. So it comes down to entry level. It comes down to entry criteria and the level of confidence you have going in as a trader, right? So first things first, if you're a beginner watching these videos, which this one is typically tended for, you would typically, what the retail's trader would say, you would come in, and what you would do is you would come and you would enter just where the neckline is, right over here. And if it kind of breaks out, comes back again, and then moves upwards, you'll typically set your take profit to be something like that. Now, if you are a beginner, yeah, that is a good area to have. Now, there is a point where your stop loss would either have to go below here, or it may go, depending on how your risk management has set out, it may be below or it may be in the middle. If you are a pro, then you will look at taking your entry roughly around here. Now, the reason why you take your entry roughly around here is because there'll be certain candlestick patterns that would form, and also there'll be other EMAs, exponential moving averages, that would align here for you to take your entry here and have your stop loss below the second leg versus waiting until you get all the way up here. But that would really depend on your level of confidence and really how much experience you have trading. So the retail beginner way would be up here, while the entry level for those who are more seasoned in trading would be roughly around here. All right, so with that said, let's go and see some of these in action. So here we have a W formation here. The trade that I'm looking at right now, the pair in this particular part is coming from gold, which I will cover in a different video, talking about all the intricacies of gold and how volatile it can be and how you can actually use it to your advantage. So what we have here, if you notice, there's a couple things. Number one, this is the Asian session marker over here. And what you can also see here is a small M formation. This is more of an advanced part over here. This is known as a type 2 M formation, and you can just about see it. There's a little M structure, comes up, comes down over here, comes back up, and then drops down to here. But what we're interested in right here is we're interested in this W formation. Now, in this case, it doesn't look anything similar to this, but this is more of a textbook version of a W, whereas this is what you would see in real life. So here we have this W formation here, and there's a couple things I want you to know when looking at an M or a W. The amount of candles that go in between the first and second leg is important, as much as the amount of candles that are used in total is also very important here. So what you see here is we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, and so on. There's more than 8 candles, and that's going to be one of the prerequisites of looking of should I get into this trade or not. Is there more than 8 candles? Thus 8 candles equals, on the 15-minute time frame, about 2 hours. So that's that part here. Now what do we also see is this. The first leg gives us this pattern over here. I'll talk about that pattern in a different video in more detail, but this is called a star formation here. So this first leg comes up, and what I would typically do is have a line drawn right here. So as I see the market makers are inducing, you can see here, it's just going sideways, it's not going upwards, it's not going downwards, it's just going sideways. What does that mean? That means that the market makers are inducing people to go long, to go short, to go long, to go short. All these wicks, all these things here are traders that are putting their stops in, putting their trades in, and their stops might be somewhere else. Now, what you also notice here is that this low here, this low over here, is lower than this one. Now, there is another video I'll be making around the TDI, which I'll come back to this this one over here, and we'll go in looking in more detail and see how there's something called divergence, which could help aid in regards to making a higher probability setup like this one is. So, first leg over here, lots of candles in between the first and second leg, great. It taps the 13 EMA a bunch of times before it does anything else, great. And what we have here, we're looking for price to go below and then close back above. So what we see here is this pattern here, this candle pattern over here is that second leg. And so what you would do is you would have the entry about here. If you're waiting for the neckline for that to be broken out, that's roughly in this area over here. And then you set your stop loss. Now your stop loss depends on, like I said, how many pips you can afford to lose in this particular trade. Once again, that's all about risk management, which I'll cover that in a separate video as well. And so you can see here, price now starts to move out of the area which it was going. So before you could have went, this is a breakout, which it is. You can see here, it hits all the way to the downside, creates a W, and then shifts upwards. And as you can see here, with gold, it is a lot you can take with this. So in my gold video, I'll do an example and a breakdown of what you can look to earn depending on the type of lot size you have and how many pips you're going for, etc. So that's the W part of it here. Okay. If we now look at the M formation here, what do we see here? So this is now the M formation. Now this is sort of what is called a type 2, and once again this would be more the advanced part here. And we see a couple things following. So what we see is this Asian section over here, and now what we see is this here. So this comes up here, comes down, comes back up, and then it drops. Now that's really good to see. And if I just take the pointer and I did a little erase, I'll come back here again. If I draw a line out, once again, draw a line out, cut it in between here. You typically would like to do this anyway, just to keep track of what's happening. Now we can see here, the dealers come up, the induced traders go short, they come way back up with a nice shift candle. This shift candle right here, what that's telling me is, oh man, I missed it the first time when I came up this way. Now it's coming back up. Right, I don't want to miss it the second time. People who do breakout trades will look at that and go, right, time to buy. What the market makers do? What they did is quite, well, to be honest, I've been doing this for quite a while. So for me, it's normal, but it is quite ingenious at the same time. So this pattern here, so we have this here, and now we have this here. This pattern right here, this little pattern right here is your second leg. Now it is called, I call it a partial railroad track. The reason being is that if you were to take these two candles right here, put them together, it will equal the length of this candle right here. So in 45 minutes, the market makers came up, came back down, and then closed below this first leg line that I've drawn over here. And then it roughly closed on the EMA over here. Now, that being said, if I go back to here and we go and look, now we're going to look at this. Where exactly should we get in from? So once again, line here, you can get on this 13 EMA over here. So you could try to get in here. If you're an advanced entry, you would get in here. The neckline is down here, which means you would get in here if you are a beginner. And then you set your stop loss maybe above here. Because this shift candle right here shifts you out of the zone of where you're at. If you're entries here and your stop loss, let's say, let's make a little SL up here. Not the best drawer, but anyway, your stop loss is up here. The market makers don't come back to there, and then effectively, as you can see here, they head downwards over here towards this 800 EMA over here. So that's going to be quite important as well, and it's quite an interesting take on the situation. But what you can see here is that that is your double top, just in a different way. So with that in mind, I hope you guys found this video interesting. Please comment below. Let me know what you think about the video. If there are any future topics you want me to touch on, or just have any questions or comments on the quality of the video, that'd be great for me to know. It's great feedback. And with that in mind, I hope you guys have a great day. This is MTM, signing out.